Kevin is 46. Kevin has $0 in a brokerage account, and for the last 5 years, he's told himself the same thing every time dividend investing comes up. Once I've got a real chunk of money saved up, 10, 20 grand, that's when I'll actually start. Marcus is 45. Marcus also had $0 5 years ago. But Marcus didn't wait for a lump sum. He opened an account, set up an automatic transfer of $50 a week, the price of 2 decent lunches out, and let it run. Today, doing the exact same math we're about to walk through together, Marcus is over $52,000 ahead of Kevin. Not because he picked better stocks, not because he makes more money, because he started the clock 5 years earlier, on nothing. If you've got $0 sitting in a brokerage account right now and you've been waiting for the day you finally have enough to get serious, this video is going to show you exactly why that day is never coming and exactly what to do instead, starting today, with the two of us, right now. Here's what we're covering. First, the exact dollar number your dividends need to hit to pay you $500 a month. I call it your dividend freedom number, and you're going to calculate your own by the end of this video. Second, the specific weekly dollar amount, not some vague invest what you can, that gets you to that number on a timeline you pick. And third, the two funds, one that grows and one that pays you monthly, that this entire strategy runs on. Let's start with the number. Here's the thing about starting at $0 that nobody tells you. For the first few years, it is genuinely going to feel like nothing is happening. Not slow, nothing. That's not a flaw in the plan. That's the plan working exactly as designed. I call this stretch the $0 runway. And it's the single biggest reason people like Kevin quit before they ever really start. Compound growth doesn't look like a line going up at a steady angle. It looks flat for a long time, and then it bends. Hard. If you're staring at your account after 8 months and it's grown by a few $100s, your brain is going to tell you this isn't working. Your brain is wrong. You're just standing on the flat part of the runway. Everyone who eventually takes off had to taxi down this exact stretch first. There's no version of this where you skip it. Maybe you've got exactly $0 like Marcus did. Maybe you've got a few thousand sitting in a savings account earning next to nothing while you decide what to do with it. Either way, the runway ahead of you is the same length starting today as it is starting after you've figured it all out, except today's version starts sooner. That's important. But knowing the runway is flat doesn't help you if you don't know exactly how long it is for your specific number and your specific weekly contribution. Let's fix that. Your dividend freedom number is simple. It's the total portfolio value you need, sitting in dividend-paying investments, to generate $500 a month without you touching the principal. The formula is your monthly target, times 12 to get an annual number, divided by the actual yield your portfolio pays. So, $500 times 12 is $6,000 a year. We're going to build this portfolio around a realistic blended yield of about 4.5%. I'll show you exactly which two funds get you there in a minute. $6,000 divided by 0.045 is roughly $133,000. That's it. That's your dividend freedom number for $500 a month, not $1 million. Not some untouchable finance guy fantasy number. $133,000, generating $500 every single month forever, growing most years without you selling a single share. If you want to run this exact calculation on your own target, maybe you want $300 a month, maybe you want $1,000, there's a free dividend Snowball calculator waiting for you in the description. And if you want the weekly contribution tiers and the DRE compounding automated instead of doing it by hand like we're about to, that's exactly what the full dividend income toolkit does too. Now, $133,000 sounds like a big number when you have $0. That's important. But a target number means nothing if you don't know exactly how fast you can actually get there. Let's fix that. Here's the part most dividend videos skip because it's not as fun as picking stocks. The number that actually decides whether you hit $133,000 isn't your stock picks. It's your weekly autopilot, the automatic transfer that moves money into your account whether you're paying attention that week or not. Quick mechanism check, because this word is going to come up a lot. DRIP stands for Dividend Reinvestment Plan. Every time SCHD or Realty Income pays you, instead of that cash sitting there, your broker automatically uses it to buy more shares, often fractional shares, down to the penny. Every share you own that way pays you its own dividend next quarter, which buys a little more, which pays a little more. That's the actual mechanism behind the runway bending. You're not doing anything differently in year 15 than you were in year 1. The shares you already own are just doing more and more of the buying for you. I'm going to show you 3 real weekly amounts and how long each one takes to reach your dividend freedom number. All 3 assume an 8% average annual total return, and I want to be upfront that's a conservative number on purpose. It's below the stock market's long-run historical average. It assumes every dividend gets automatically reinvested through DRIP instead of cashed out. And it assumes this is happening inside a Roth IRA, so there's no tax drag slowing it down. If money's tight some months because of a car payment or a kid's expenses, start with the smallest tier anyway and adjust it upward later. The runway doesn't care how small the first years are, only that they exist. $25 a week, less than $10 every other lunch, gets you to $133,000 and $500 a month in dividend income in about 28 years. $50 a week gets you there in about 20 years. $100 a week gets you there in about 14 years. Look at the spread there for a second. Doubling your weekly amount from $25 to $50 doesn't just cut your timeline in half, it cuts it by 8 years. Because you're not just contributing more, you're also giving compounding a bigger base to work with earlier. That's the same math whether you're closer to the $25 end or the $100 end. Small changes to your weekly number move your finish line by years, not months. Let's actually walk through the middle one because the shape of this curve is the whole point. $50 a week is roughly $217 a month. After 5 years of $217 a month at 8%, you've got about $15,900. If you check your account at that point and feel like this is barely working, that's the $0 runway talking. Keep going. By year 10, you're at roughly $39,600. Notice that. It took you 5 years to build $15,900, but only 5 more years to add $23,700 on top of that. The runway is starting to bend. By year 15, you're at about $74,900. You've added $35,300 in that stretch, more than what you built in the first 10 years combined. And by year 20, you cross roughly $128,000, an additional $52,800 added in that final 5-year stretch alone, which, if that number sounds familiar, is exactly the gap we opened this video with between Marcus and Kevin. That's not a coincidence. That's what 5 years of head start is actually worth once compounding gets its teeth into it. Push a little further to about 20.5 years, and you're at your full $133,000 dividend freedom number, generating $500 a month every month without you selling anything. That's the math. But the math only works if it's actually going somewhere specific. Which funds, which account? Let's fix that. You don't need 14 dividend stocks to make this work. You need 2, split roughly in half, and I call it the half and half split. If you've made this mistake before, a lot of people watching this have, this might feel almost too simple. Maybe you've tried this before with 10 or 12 different dividend stocks scattered across accounts, and it never quite compounded the way you expected because each position was too small to matter, and half of them didn't even reinvest automatically. 2 funds split in half, both on autopilot, is the fix for that specific mistake. Half your contribution goes into a dividend grower. The standard here is SCHD, the Schwab US Dividend Equity ETF. As of this recording, SCHD yields about 3.3%, and it's on pace for its 15th straight year of raising its payout, with a dividend growth rate that's outpaced inflation for over a decade. SCHD isn't the highest yield you'll find. That's the point. It's built to grow. The other half goes into a dividend payer. The standard here is Realty Income, ticker O, literally nicknamed the Monthly Dividend Company. As of its most recent declaration, Realty Income has paid 673 consecutive monthly dividends without a single miss, and it's currently on its 135th straight increase, yielding right around 5.1%. That's a real audited public company track record, not a marketing claim. Blend those two 50-50 and you land right around that 4.5% yield we use to calculate your dividend freedom number. Tilt more toward Realty Income and your number gets smaller, but you're more concentrated in real estate. Tilt more toward SCHD, and it takes a little longer, but you're more diversified. That's your call. I'm just giving you the math. One more thing on the account, because this audience asks about taxes more than anything else. Do this inside a Roth IRA if you possibly can. The 2026 contribution limit is $7,500, and the income cutoff for contributing doesn't kick in until $153,000 for a single filer or $242,000 married. So if you're in the income range most people watching this are in, you're not locked out. Inside a Roth, none of the usual dividend tax headaches apply. You don't have to think about qualified versus ordinary dividends and REIT payments like realty incomes, which the IRS normally treats as ordinary income, even though there's a 20% deduction now permanently written into the tax code for them. Just don't matter, because Roth withdrawals aren't taxed at all in retirement. Concretely, here's the sequence. Open a Roth IRA at a zero minimum, fractional share broker. Fidelity and Schwab both work. Set up an automatic weekly transfer for whichever number you picked. Point that transfer at buying SCHD and Realty Income, split roughly in half. Turn dividend reinvestment on for both, so every payout buys more shares automatically. Then leave it alone. That's the entire system. No 14 tickers, no active trading, no checking it daily. And here's why 2026 specifically matters. The Fed has cut its benchmark rate from over 5% down to the 3.5 to 3.75% range this year. That matters for realty income and REITs generally, because their whole model runs on borrowing to buy real estate. Cheaper borrowing costs make that math easier for them. REITs like Realty Income traded at multi-year lows during the 2022 to 2023 rate hike stretch, precisely because higher rates made their borrowing costs and their competition from safe bank yields worse. That headwind has been easing since, which is part of why this is a reasonable window to be building this position. Not a reason to rush. Before we recap, one warning, because I'd rather you hear it from me than learn it the expensive way. At some point, you're going to see a fund or a stock yielding 9, 10, 12%, and it's going to feel like a shortcut past everything we just calculated. Be careful. Here's why those yields get so high in the first place, and it's worth understanding the mechanism, not just the headline. Yield is just the dividend divided by the share price. When a company's business gets shaky, the stock price usually falls before the dividend actually gets cut. So for a while, that falling price makes the yield look bigger and bigger, right up until the cut finally happens and the yield resets down to something normal. Except now you've also lost a chunk of the share price. The high yield wasn't a reward. It was the market quietly pricing in bad news before you saw it. AT&T investors watched their dividend get slashed 47% in 2022 after years of treating it as one of the safest income stocks in America. Intel, a company that had paid a dividend for decades, suspended it completely in 2024. Both were popular, both looked safe right up until they weren't, and both wrecked the dividend freedom number math of anyone who'd built their plan around that yield. Stick with the grower and payer split. Boring on this channel is the whole strategy. Let's bring it back together. You've got the $0 runway, the flat stretch at the start that feels like nothing's happening and isn't a sign you're doing it wrong. You've got your dividend freedom number for $500 a month at a 4.5% blended yield. That's about $133,000. You've got your weekly autopilot, $25, $50, or $100 a week, landing you there in roughly 28, 20, or 14 years depending on what you can actually commit to right now. And you've got the half and half split, SCHD to grow it, realty income to pay it, inside a Roth IRA so the tax questions disappear. Here's what I actually want to know. Drop your realistic weekly number in the comments, not the number you wish you could do, the one you can actually commit to starting this week, and I'll reply with roughly how many years that puts you from your own $500 a month number. If you want the full lineup beyond just these two funds, the complete tier system for what to hold at different portfolio sizes, go watch The Best ETFs to Live Off Dividends in America next. It picks up exactly where this one ends. Kevin's still waiting for his enough. Marcus started with $0 and a Tuesday. The only difference between them 5 years from now is going to be a number. And now you know exactly how to calculate yours.